Stock market for beginners. That's what we're talking about today. Before we start, let me introduce myself. I'm Austin. If you're new here, I'm a co-owner of cloudmusicsuite.com and a stock market investor, of course. On this channel, we talk all things money and personal development. So if that sounds up your alley, go ahead and subscribe. And as a thank you for subscribing, here's a picture of my beautiful kitty cat. All right. Thank you for subscribing. Okay. We're going to talk through 10 topics about what is the stock market. Okay. So we're going to go through what is a stock, what is the stock market, how to access the market, how to buy stocks, different kinds of securities you'll see, winning strategies, in my opinion, risks, rewards, expectations, and everyone's least favorite thing, taxes. Okay. So let's go ahead and start at the very top. All right. What is a stock? You hear stock market, like what even is a stock when you're buying stocks? So a stock is an ownership piece of a company. So whenever you go into the stock market and you see these ticker symbols, like maybe you're looking at Amazon and you're looking at Amazon stock, it's like, well, yeah, that really does represent ownership position with Amazon if you're to buy those shares. So the stock market is basically this playing field where companies can bring their ownership shares over to a public market, the stock market. And then investors can say, I want to buy this stock. And the company said, well, you can buy this stock, this little sliver of the ownership of this company for $100. So that would be the share price. They're going to start the stock at $100 whenever they first go public. That's what they want from an investor. You say, I think that's a good value. I'm going to buy that for $100. You're now an owner of that company. Yes, that ownership is very small, but these ticker symbols and all these things you see, if you watch like a CNBC News, you see at the bottom of the screen, it says like 4 little letters or 3 little letters and some percentage up or down. Yeah, those are real companies, okay? So you are investing in a company. So you get ownership position, which means you're entitled to profits from that company. And you can make substantial amounts of money over time if you're picking great stocks. So that's kind of like what is a stock and what is a stock market? Ownership position, and the stock market is just where we exchange that ownership position for monetary value. All right, so you give money, you get ownership position. You give away your ownership position, you get money in return, also known as selling a stock, right? So that's kind of what is the stock market. How do we access the stock market? So back in the day, you used to have to like call a broker and call up a guy on the phone and say, hey, I want to buy 100 shares of Intel Corporation or something. And you wire them the money, et cetera, et cetera. It's no longer like that. Thanks to the internet, there are online just broker houses or brokerages. So some of these brokerages, I'm just going to list off some off the top of my head. Charles Schwab, Vanguard, Fidelity, Robinhood, I'm sure you've heard of, SoFi, E-Trade, M1 Finance, et cetera, et cetera. The list goes on. They all pretty much do the same thing. They're going to, it's a medium where you can access the stock market. You make an account with, let's say, TD Ameritrade, and then you open an individual brokerage account. And with that individual brokerage account, you go ahead and add money from your bank account, you put it into your brokerage account, and then in that brokerage account, you go ahead and buy stocks with the money you funded into the account. So the stock account itself is not the investment, right? So we've heard of IRAs and 401ks. The IRA is not an investment. The 401k is not an investment. The brokerage account is not an investment. That's just an account that allows you to access the stock market. All right. So inside of those accounts that allow you to access the stock market, after you've opened one, maybe you open a Roth IRA, which I have a whole nother video about, or you open a traditional brokerage account that's not tax advantaged. You go ahead and put $100 into that account. Now you can buy $100 worth of stocks. Maybe you buy one share of one stock for $100. That's all your money. Now you're fully invested. You'd have to add more money to that in order to buy more stocks. All right. So that's kind of how you access the market. You go through a brokerage. All right. So go ahead and make a brokerage account and you can access the stock market. Number 4, how to buy stocks. So stocks are split up into shares. All right. So a share of a stock is a teeny tiny little sliver of that stock. The company decides how many shares there are going to be of this particular company. Amazon decides how many shares they're going to issue. And then each one of those shares represents like 0.0000001% of ownership of that company. If you buy a bunch of shares, you have a higher ownership position. If you buy a very small amount of shares, you have a lower ownership position. So buying one share at a time, that's just how they break it up. It's really just random math for them to say, here is the market capitalization. And market capitalization is the total worth of that company. So Apple is above a $2 trillion market capitalization. So you would think, oh, well, the stock price is really high. No, not necessarily, because what they can do is they can say, we're going to issue a certain amount of shares. And when they issue a certain amount of shares, then the stock price is determined by taking market cap divided by total amount of shares outstanding. And that's why you can see some of the most huge companies in the world, some of the biggest companies in the world, like Apple and Amazon and Microsoft, their stocks are only trading for like $100 to $200 to $300, right? So they can get tricky with like how they decide to value their stock in terms of US dollars. It's just about shares outstanding. We don't need to get too crazy about it, but one share is how you buy a stock, right? You buy one share at a time or 10 shares at a time, or whatever the case may be. The way that you actually buy stocks is you go through whatever brokerage you're with and you click the word trade or buy or sell, or, I don't know exactly, different brokerages are different, but you click the buy button and then it's going to offer you to buy a certain amount of shares. You can buy, most brokerages even offer fractional shares now, but you can buy 1 share, 2 shares, 3 shares, 5,000 shares at a time. There's really no limit on how many shares you can buy at a time of a company. And we're probably not working with big enough numbers where you would have to worry about it anyway. So you just select how many shares you want. The brokerage that you're going through will do the math for you, and they'll tell you this is probably going to cost you, let's say, $300.50 to buy this amount of shares of X company. You click submit, and then there's 2 main options that you can do. You can do a limit order, or you can do a market order. A market order just goes with, okay, the stock last was bought or sold at this price, and now you're going to get that exact price as well. So the order is going to get filled pretty much instantly. If you do a limit order, then you set, if the stock is trading at like $355.50, let's say you only want to pay $355.25. You can set a limit order for $355.25, and then you can select the amount of shares you want, click submit, and once the stock trades below that value, then your order will be filled. So some people like to do limit orders, others like to do market orders. It's up to you. Cool. So next one I want to talk about is the types of securities that you'll see in the stock market. So the different kinds of securities. When I say security, I mean like an investment. So of course we're going to have stocks, so individual stocks, like we've talked about Apple and Amazon and Intel Corporation and ExxonMobil and Chevron and all those guys. Those are just individual stocks. Of course we'll find those in the stock market. Another thing we can find in the stock market is something called ETFs, exchange traded funds. So this fund is a big basket of money. You give this fund your money and then they basically invest it on your behalf. And they invest it into a certain number of companies. Maybe it's an index fund that holds an entire index, like the NASDAQ 100 or the S&P 500 or the Dow 30, right? Those are the 3 big indexes in the United States. So if you buy the S&P 500 index fund in an ETF format, you're giving a fund your money. They're taking that money and investing it into the S&P 500, which is 510 of the biggest companies in the United States. So that's like Apple and Amazon and Nvidia and Meta, which used to be Facebook, et cetera, et cetera. You can look at a list of it. So that would be an ETF. Another thing is a mutual fund. You'll be able to see mutual funds in the stock market. These are kind of like the old guard, typically like an actively managed hedge fund type deal is going with these mutual funds, and they've got all different kinds of tickers, and it gets really kind of complicated, but that's also a big basket of money. So with any fund, whether it be a mutual fund or an ETF, you are giving your money to someone else, and then they're investing it on your behalf, And as that happens, the fund price can go up over time, right? So that's going to track the value of all the stocks that are underlying that fund. So you can buy individual stocks, you can buy ETFs, you can buy mutual funds, and then there's a lot of others as well, like bonds and exchange traded notes and master limited partnerships. But I think I'm going to have to make a totally separate video for those ones. All right. Let's talk about a few winning strategies. These are proven winning strategies, assuming you're doing the right research work and being a level-headed investor. So 3 different winning strategies. Number 1 could be indexing. And when I say indexing, I mean buying index fund ETFs that have a very low fee ratio, like I was just talking about with the S&P 500 or the NASDAQ 100 or the Dow 30. All right. So we can buy, I'm going to use a random example. VOO is the ticker symbol. Okay. That's how I would look this up in the stock market. I would go to search, I would click VOO, and I can buy shares in VOO, which is the Vanguard S&P 500 index fund. So index funds are very, very low risk and low volatility. They're going to just generally move with the market. If you believe in the US economy over the long term, you should believe in index funds over the long term. Because with index funds, these indexes or indices, they change their allocation, one, based on market cap. And remember, market cap is the total amount of money that that company is worth, right? Like with Apple having a $2 trillion plus worth in terms of market cap. But anyway, so these index funds are basically rigged in your favor, because to get into the S&P 500 and to get into the NASDAQ 100 and to be in the Dow 30, you have to meet certain criteria. If you fail to meet those certain criteria, you get knocked out of the S&P 500 and someone replaces you. So it's basically continually just putting the cream of the crop in the S&P 500. And there are a few, there's a committee of people who decides, is this stock going to get dropped out? If it is, who's going to replace it? And they look at a few criteria, right? So it's pretty much rigged in your favor for indexing to be your friend over a very long period of time. Yes, you might have downs, and yes, you're going to have big ups, but over the long term, if you believe in the US economy, we're going higher. Okay, I was about to say to the moon and be memey, but anyway, we're going higher over time. That's one strategy, just putting your money in an index fund, and every single month putting a certain amount of money into the index fund and not stressing about anything, because you don't have to worry about an individual stock reporting earnings or having bad news come out about it or whatever the case may be. Next winning strategy is indexing +3. So this is a middle ground between my last strategy I'll get to in a second, but indexing +3 would be maybe you buy the S&P 500 index fund and then you buy 3 individual stocks. If you ever want to get into individual stock picking, I would tell everyone to start with indexing first. Learn about the market. Learn what market cap means. Learn how to value a stock. Learn about price to earnings ratios and price to sales ratios and statement of cash flows and balance sheet and all these terminology, mumbo jumbo lingo. Learn about all the lingo, but be invested in the index funds. And then build your position with these index funds, start getting some money behind you so that you're really working with some real numbers. And then once you feel comfortable and ready to buy your first individual stock, buy that first individual stock. You've done all the research work, you understand how the market works, you've seen the ups and the downs, you've made a few mistakes maybe even, you've lived and you've learned and you've gotten better over time. That's all we really need to do. So you buy your first stock, you researched it, you put a lot of time into figuring out this company's opportunity, why it's better than its competitors, why its earnings are going to increase over time, etc., why its revenues are going to increase over time, and just the general growth story. And then you pick 2 more. So now you have index funds plus 3 individual stocks that you believe in. Watch these growth stories play out. See if you did a good job picking stocks or if you were just horribly abysmal at picking stocks. Maybe you have a lot more to learn before going out and selling off your index funds and going into individual stocks only. Maybe you're ready to go. So there's my third strategy, is just individual stock picking and building your own portfolio. That would be number 3 winning strategy. Definitely a winning strategy. And my book that's right behind me, One Up on Wall Street, Peter Lynch talks all about this, how smart money, big Wall Street money, you actually have an advantage over them because we have all the same information as big money does, but you have your own specific niches. You have your own specific things you already know about. There are industries you're very familiar with. Go into those industries and find the winners, find the diamonds in the rough, find the undervalued companies in there. You can absolutely do this. So building your own portfolio of maybe 10 to 15 to 20 stocks, definitely a winning strategy. Yes, it takes way more research work over time, but certainly can, I'm not going to say you can beat the market, but it is very, very possible to outperform the market on a regular basis, like what Peter Lynch did. I'll just put that out there and say that. I know there's a lot of people who say, well, you can't beat the market, just invest in an index fund. I disagree. Anyway, let's talk about risks with the stock market. The biggest risk with the stock market, technically, is that you lose all of your money and a company goes bankrupt. That's the risk. That's the biggest risk that exists, right? A stock goes to zero. That's possible. Maybe you picked a terrible stock, a trash stock, some biopharmaceutical company that was not in a cash advantage position, and they go bust, they go bankrupt. Happens all the time, okay? There was a company called Voyager Digital recently that went bankrupt. People were like, oh, it's the next Coinbase. It's gonna be a great, 1, 2, skip a few, they went bankrupt. People lost tons of money on this company. So risks are, you can lose everything. And then you can pretty much go anywhere between not losing any money at all and losing everything. All of that breadth right there is the risk in the stock market. If you start doing shorting, which we're not going to really talk about this in this video, you can lose well past 100%, which is completely ridiculous. So let's just stay away from that. Okay, those are the risks. In general, understand that it's very possible that you lose all of your money and the company goes bankrupt. If you're picking good stocks that are in a well-capitalized position, that have a great balance sheet, they have a lot of cash on hand, they're growing revenues and earnings over time, quarter after quarter after quarter, they have a great management team, they have a moat around the business, meaning it's hard to compete with them, probably not going to go bankrupt, okay? Probably not going to go bankrupt, but it is possible. Let's talk about rewards. The rewards in the stock market are pretty close to unlimited. There are many, many stocks that have been up 10,000%, 20,000%, 30,000%. Okay. Yes, it's going to take time, but if you were an investor in Apple in the 90s, oh my God, you have made so much money over the past 30 years. It is ridiculous. The sky is the limit for rewards. I personally have multiple stocks that have been 1,000+% gainers. It's amazing. It's completely ridiculous. Like I set my growth trajectory. I believe this is the growth rate they're going to hit. I believe this is what's going to happen. They're going to execute this way. And then it just goes way better than I thought. So once we get to like 70 to 80 to 100% gain, which would be a double up, and then 200% gain, which is a triple up, 300% gain, which is a quadruple up, right? Life-changing money. Absolutely life-changing money. So the rewards are beautiful, and they are many and they're plentiful. And if you are a great stock picker, you can have a lot of rewards. Even if you have a few losers who are maybe like down 20 to 30%, that's tough. That hurts. But if you have one 100% gainer, he's going to take, one loser, one 100% gainer, 100% gainer, the home run stock. The 10 bagger, if you get a 10x like Peter Lynch calls it, it's going to seriously outweigh those few mistakes that you make. So the rewards are absolutely ridiculous, and the sky's the limit, like I said. So that said, let's get some realistic expectations out there. The S&P 500, since its inception, has gone up about 10.5% per year. So somewhere around 10.5% should be pretty much our expectation per year. Because if you invest in just the index fund, you're going to get about 10.5% on average. Some years are going to be crazy high. Some years are going to be crazy low, but 10% on average. So if you're about to try to be an individual stock picker, you better be getting at least 11%, 11.5%, 12%, 13%. If you're edging on like 15, 16, 17%, you're a beast. If you're up near 20% annual returns, you're an animal. Okay, if you're like Peter Lynch, One Up on Wall Street author, ran the Fidelity Magellan Fund, 27% a year, dude. Animal, arguably the GOAT. So we shouldn't expect I'm going to double up my money every single year. No, dude, not realistic. Probably not going to happen. You will have some really, really good years, especially if you're an individual stock picker, but you're also probably going to have some pretty bad years. As long as there's more good than bad over the span of your investment horizon, you'll be in a great spot. But just know that you shouldn't be expecting 40, 50, 60+% annual returns. It's just not realistic. In a bear market, yes, you'll have some great years. I meant to say bull market, whoops. In a bull market, yes, you'll have some great years. In a bear market, you're gonna have some terrible years, but that's okay as long as we're going up over time. So there are expectations, should be getting more than 10% a year in my opinion, especially if you're gonna go pick individual stocks. You better be at least getting a few extra percent over just indexing, because indexing is like easy. Like you don't have to do any research work to be an index investor. So you gotta have some motivation in terms of like you're actually good enough to get 13, 14, 15% to be like real good. All right. So those are some general expectations about 10% a year. Last thing I want to talk about is taxes. If you are investing in a Roth IRA, you get no tax advantages today for investing in your Roth IRA. But after the age of 59 and a half, all your profits are tax-free and all your dividends are tax-free. If you're investing in a traditional IRA, individual retirement account, you get a tax write-off for the money you contribute to that account today. So we can help our tax situation that way if you want that. But after 59 and a half, you get taxed on your investment gains whenever you start taking money out from this retirement account. Same thing with a 401k. You get a tax break this year, but you have to pay tax on the gains whenever you're taking this out past the age of 59 and a half. If you're in a traditional brokerage account and it's not tax advantaged, it will probably just say individual brokerage account or traditional brokerage account. You have to pay tax whenever you sell your investments for a gain, okay? You have to pay tax whenever you get dividends. So don't go putting $10,000 in, double up your money, sell, now you have a $10,000 gain. You gotta pay taxes on that, okay? You have to report that to the IRS or else they're gonna be on your back for probably the rest of your life. So must pay taxes if you're in a regular individual account. That said, if you wait 365 days before you sell a stock, from the day you buy it to the day you sell it, at least 1 year, then you get what's called long-term capital gains rate, which those tax rates are way lower than a short-term capital gains rate. And a short-term capital gain is what happens when you hold something for less than a year. Less than 365 days, you've got short-term capital gains. And now you've got to pay your individual income tax rate, which I guarantee is going to be way higher than the long-term capital gains rate. With dividends, there are two different main types of dividends. There are other things with limited partnerships, but we're just going to talk about ordinary dividends and qualified dividends. Ordinary dividends are taxed at regular income rates, so that's not ideal. We don't really want ordinary dividends if at all possible. We want qualified dividends. So qualified dividends are taxed at the long-term capital gains rate. So just something to think about. The tax man is real. He still wants his cut. If you're investing in a account that's not tax advantaged, you have to pay tax. So I don't want anyone getting in trouble because they didn't pay taxes on their investment gains. Just something to think about. All right, that was a lot of stuff in that. That's Stock Market for Beginners. Save this video, watch it later. You know what to do. Hit the like button and subscribe if you want to see more. I hope you got a lot of value out of today's video. Have an amazing day.